welcome everybody to the Capital Discussions Market Analysis. I'm Tom Nunnermaker with Jim Riggio. And before we get started, we have our disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. And hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer that you're seeing is at the bottom of all of our web pages, so you can read it in detail at your leisure anytime you like. So with that, actually, I guess I should keep sharing my desktop because Jim's actually on the road, so I've got Jim's Thinkorswim up with his oscillators, so everybody should be seeing that now. And we're looking at the SPX with all of your oscillators, Jim. The oscillator is one group.
Okay, great. So, if when we take a look at where we are on the top of it, what you'll end up seeing is that we basically have bounced through all of the moving averages, okay, on the top sheet. Now, the interesting thing is that you go through the oscillators, and as we talked about this last week, what ends up happening is that you take a look at the MACD, you take a look at the stochastics, you take a look at each of them, and you can see that the strength of the move is it's waning. It's not nearly as strong as it had been, and you're getting that pretty much in confirmation across the across all of them. Tom, as you go down, do you see any of them starting to roll over and come down yet?
Well, the only one that maybe is a little bit weaker than the rest is the CCI indicator, but it's still very strong.
Right. Now, CCI, we've talked about this, especially on the equities. It's the one that tends to end up rolling over the first one to roll over. You do get lots of false signals with the CCI, but so now that we've had the first one, just starting to end up losing some of its momentum, it tells me that there's, we at least need to end up being a little bit concerned. We spoke in previous weeks. We said it was moving up, was getting stronger. And it looked like it was amazing how quickly it ended up moving up. But at this point, the market seems to be somewhat slowing in its ascent. Now, one of the things that was the most amazing to me is, Tom, would you pull up a VIX chart, and you can end up deleting all studies, okay? Either that, or if you want to go up to the yellow square, there's one that says basic. So what I wanted to talk to you a little bit about was the VIX. One of the things that Ian Scott, who was on, I guess about a month ago, and I have been trading now in a prototype account for some of his partners, is a volatility strategy where we're basically trying to end up having it be a neutral strategy. Have some trades that are bearish on the VIX or on VIX ETFs, and then others that are bullish. And one of the challenges that we end up having is that when we have a regime change, a very technical, that the quants end up loving talking about regime changes, where they'll end up going from a bearish to a bullish or from a bullish to a bearish. In the last maybe 5 weeks, on this VIX chart. Do you have it up, Tom?
I do. The VIX is up.
Okay. The VIX, as long as you're looking at least a 2-month period on it, what you'll see is that the VIX basically went from 13 to 31 and change back to 13 or 12 and change. I went back and I tried to end up taking a look at any time where we had a movement of going up like 125% and then back down in such a short period of time, and I couldn't find anything since the VIX futures have been trading that we've had that level of 2 regime changes that quickly. You know, we went from, you know, being flat to a little bit bearish on, you know, with the VIX coming down over the last several years, and then have it just, you know, rocket up and then come right back down that much. You know, one of the things that I had shared, and you don't have to end up showing this, Tom, but I showed a UVXY trade since it first started to end up trading. And everybody knows that it's gotten absolutely killed. But here was the most interesting thing to me with it. It was the first time that we ended up, okay, getting above the 200 and the 250-day moving average on the UVXY. That was really substantial. And as quickly as we got up there, we've come back down. I don't know, okay, what happened with Len Yates' indicator. If anybody does, I'd love for them to end up sharing it. Because from what I had seen, this was like the perfect storm that would have hurt his strategy the worst. You know, you wait until you get long the VXX, and if you did do that, you got in at, you know, pretty inopportune time, and you're going to have to end up getting out very quickly. Now, hopefully, and from what I had seen in a lot of other things from Len and stuff, he probably did take, hopefully, a relatively small loss, and then get to be a long XIV, which is the same thing as being short UV, I'm sorry, same thing as being short VXX. But it was a really, really nasty move back and forth. Anyway, one of the things that we've seen for the last, you know, several weeks, while the VIX has been coming in, and the VXX has been coming in, Tom, and if you could end up bringing up a 15-minute chart on the VXX for maybe a 2-week period, or if you have to go to an hour chart, that's fine. One of the things that you'll notice, sorry?
All right, I'll start with a 30-minute, if that's okay.
30 minutes, fine.
Okay.
One of the things that you'll notice here is that over the last couple of weeks is that we've had downward pressure every day at the end of the day. As long as the market wasn't selling off hard. What we've seen is a downward pressure on the VXX. And I use the VXX because the VXX will not only include the overall volatility level of the futures, but it'll also end up showing you the contango versus backwardation. So it's kind of like, if I was going to look at just one index, this is the one that kind of ends up having both the futures contango backwardation issue and the overall level of VIX. Anyway, so you see this downward pressure over the last couple of weeks since we reached 31, just was kind of interesting. And if you have up the 15-minute chart, you can take a look in the last half hour. This is the first day that the market broke with that pattern. And if you switch over to the E-minis, and I don't know if you can up, oh, you know what? If you go to the trade tab, an active trader, I probably have it set up there for you to look at.
For ES?
ES on the top, VXX on the bottom. Is that what you have on the active trader in the trade tab?
Let's see. It's ES and NQ.
Okay, if you would end up putting ES on the top and VXX on the bottom, give me 15-minute charts on both of them. This way we can actually see them up and down with their volume.
Okay.
Anyway, as Tom pulls that up, what you're going to end up seeing is that the last 15-minute, the last two bars, 15-minute bars in the E-minis, okay, from 3:30 to 4 o'clock Eastern time, the E-minis pushed higher, okay, for at least the last couple of weeks, okay, as, you know, since the 15th of October, we've seen the E-minis push up a little bit on most days in the last half hour, and the VXX, you know, moved down. That didn't happen today. the VXX, I mean, the E-minis pushed up in those last two bars, and so did the VXX. Are you seeing that, Tom?
Well, I see from 2145 to 2200, ES was up, VXX was down, and then the last half an hour, it was, I guess, well, they both look down to flat.
Okay. If you go to 1 minute charts, are you looking at 1 minute charts? Because that's what I think I had left out for you.
That was 15 minute.
How many?
That was 15-minute chart.
Why don't you go to 5 minute charts and you'll be able to see some of the granularity a little bit better, or even 1 minute charts. Okay, so the last half hour, last 45 minutes. It was right. And I'm only looking.
Not have something set right.
Okay, it's not critically important. I did want to end up being able for people to get the visual on it, but this was, to me, if there is any sell-off, and I'm not saying there is, I don't think there's going to be, but to me, it could have been just that the VXX has been pushed down so far that it just had to end up having a little bit, but the contango, okay, percentage, and instead of me trying to get you to the graph, Tom, if you go to VIX Central on any web browser, the contango had gotten up to 5% during the day. I didn't look at it when it closed. But it got back to, things being more normal. Now, when we're in early November, looking at, Thanksgiving and into the holiday season, this is normally the time, right? This is normally the time where volatility starts to end up getting a little bit pushed down. Now, we've gotten so crushed going from 31 down to 13. Some people might say, well, how much lower can you end up going into the holidays? Yes, they took it out very quickly once they realized that the quantitative easing programs, both in Europe and Japan, were going to end up easing the selling that was there. That volatility really came out of the market. Anyway, the bottom line, you see that, right?
Yeah, I've got VIX Central up right now, and you can see you're definitely in a nice contango state.
Right. And, if anybody wants, you can go to history and go back 2 weeks, and you don't have to do that, Tom. They can do it on their own, but you ended up seeing the backwardation, let's move into backwardation and back into contango extremely quickly. And when you take a look at the levels that the VIX was at, it really was a double reversal in terms of the regime. First of it selling off slightly, okay, after we got through the sell-off at the end of July, beginning of August. Volatility came back into line. Looked like we were going to end up drifting sideways to down into the end of the year. And we rocketed up, okay, it came right back down very, very quickly. Very, very quickly. This is one of the reasons why I'm not a huge fan of the multiple adjustment type trades. One of the things that I take a look at is that if you have on reasonable risk-reward trades and you can withstand the loss, once the market ended up ripping up to the upside, if you could just consider that money lost and then put on new trades to the downside, and I'm talking ripping up, meaning in terms of volatility trades, right? If you're trading VIX, okay, it would be the exact opposite. We're talking market. But given that, if you were to put on longer-term verticals, okay, in terms of any of the volatility, those trades worked out absolutely great. The key, I end up thinking, okay, and what I've really focused on over the last 6 months, and we're building out some of our sizing, okay, in terms of one trade versus another, because we kind of have our trades in, Scott and I do. We're really looking at putting on trades and monitoring what our maximum risk would be, even if the trade ends up running against us. And one of the things that Ian is very very, very strong about as a professional trader was what happens if. I mean, he is I'm going to use the word neurotic about losses. How can I lose money here? How can I lose money there? And once that is set, then, it really doesn't hurt. When you have trades where you're risking one to make two in terms of a butterfly or some type of a back ratio, or risking one to make three, if you lose the one, it's not a terrible thing because you end up having your trade set up. We actually blew through the downside on some of our VIX and VIX-based products trades. So that was, we hadn't seen that happen, not to that level. I mean, that was a serious move downward. Anyway, Tom, that's some of the things that I've seen. Oil seems to stabilize. Gold seems to stabilize a little bit over the last, several trading sessions. So the huge movements in the yen and the euro have really kind of, they seem to have found some level of base, and there seems to be some stability in the movement of the market, which means without all of that extra money flowing in, making both the yen stronger and the making the dollar stronger against the yen, making the dollar stronger against the euro. And you'd see that in the 6E moving up. But if you looked at not the yen futures, but if you looked at the yen dollar, it actually goes down on the graph because on the Forex exchange pair, in Think or Swim at least, they're the opposite. So, what am I?
Dollar up, and back in August it was up in the mid 130s, and right now it's at 124.20, so it sold off quite a bit, which I'm happy about. It helps my, but it's definitely has that declining pattern because the dollar's gotten a lot stronger.
Right. And Tom, the thing is that, I've told, I made the, only half-hearted with it a joke, but, for the traders, what do I end up seeing? This is a good time to be planning your European trips.
Absolutely.
Hey, they're going to end up giving you a stronger dollar. Take it. Anyway, that's what I'm seeing. Tom, any questions or any areas that you've been looking at that you want to end up adding or talking about here?
Well, let's see. I don't think there's really a lot of economic events coming up in the next couple of days. Just jobless claims on Thursday, retail sales on Friday, and then PPI FD next Tuesday. I'm not sure what that one is. Let's see. PPI. Producer price index. So those are the three market-moving events coming up in the next week or so. Any comments on those, how they might move the market?
Same thing at the end of last week. It's, I don't end up seeing the economic news pushing the markets around nearly as much as announcements or any change in central bank policy. And I say global central bank. You need to end up making sure that if the Bank of Japan, the Bank of England, or the ECB in Europe, if they start to end up changing what they're going to be doing, that would be substantial. When the Bank of England or the Bank of Japan talks, they kind of say what they mean, and they're a lot more serious. When Draghi talks for the ECB, I think that he talks a better game than he plays. So I said, I don't know if you guys have ever heard me say, when you take a look at what Draghi's trying to do to the economic, to the economy, and to the equity markets, you don't have to look past his name, right? If you take a look at his name and you actually break the letters apart, it ends his name spelled drag high, right? That's what he's trying to do. I mean, he's so obvious. Okay, it's even spelled in his name. So, you know, I say it only half-heartedly joking, but it is. It's a lot harder for the Europeans to end up acting, okay, in a single coordinated fashion versus the Americans, the English, or the Japanese in terms of their banks. So it is a much more difficult job. The only economic stuff that I ended up worrying about a little bit, and Tom, you know, your comments, I had seen some of the business economic indicators in Germany, business confidence and things like that. They tick down a little bit if you take a look at them on a 4-week rolling average. If Germany slows, I mean, that's the one bright spot in Europe. If Germany slows, Europe can be in a heap of trouble very quickly.
Yep, that's true. That's kind of the economic engine here. Stephen asked, what would be the next catalyst, possible Europe deflation risk, to manage this risk by out-of-the-money SPY puts as volatility is low?
When volatility is low, the challenge with buying puts by themselves is that it has, and you don't have live vol, so I won't ask you to end up putting this up, but it has to end up doing with the implied volatility. Maybe if you could just pull up the SPY in terms of the Analyze tab and go to the options chains of the SPY or the SPX.
Okay.
One of the things that you'll see here is that when I take a look at the implied volatility of the, let's call them the at-the-money puts versus the 25 delta put, or the 50 points below the money put, if you're looking at SPX, 5 points if you're looking at SPY. One of the things that you'll end up seeing is that the implied volatility of the lower puts ends up being much, much higher, especially when we're in, flat or, tranquil markets. When the markets get much more nervous and the implied volatility moves up or the VIX moves up, usually what happens is that ratio between the at-the-money puts and the 25% below the money puts, that ratio gets much closer, meaning that the puts below the money aren't as high as the at-the-money puts on a normal, regular basis. So when you have things and you're looking and you're worried about stuff and you want to have protection, while puts are cheap right now, one of the things that I tend to end up thinking, I'd still like to end up reducing my cost some way for that put. And what I end up doing is that I start to end up looking at rather wide put spreads. So let me give you actual examples. If you were going to end up going and buying, let's say, a 1950, okay. Tom, do you have up SPY or SPX?
I have SPX up.
Okay. If you're going to go and buy a 1950 put, what's that trading at?
Well, the one that's 39 days expiration says $10.
Okay. And how about the 1960?
1960 is at 1090.
1090. Now, if you bought the 1060, you're paying 90 cents less. Now go and sell maybe an 1875 or something like that. You'll get more than 90 cents for it, right? So I kind of take a look at and saying, how would I like to spend my insurance money and get the most value for my insurance money? Normally, okay, when the markets are like this, I'll get a lot bigger bang for my buck by buying a very wide vertical than just outright buying a put.
Like a 1975, 1950, something like that?
No, try 1960. a 1960 1900 or 1960 1875? What's
The
the 1875 rate for?
Yeah, that's, let's see, $5.20 or so for the 1960, 1900.
Okay, so you take a look at this. You haven't cut your insurance costs in half, but you've reduced it by what? 40% or so?
Yeah, quite a bit. You still have quite a lot of profit potential.
Right? So, maybe if that's maybe instead of the 1900, I take a look and say, well, what happens if I rolled it down to 1875? You take a look at what the implied volatility is, and here's the balance that you're trying to achieve. You're trying to get the highest implied volatility as you possibly can. Now, it can't be just that one factor alone, because in that case, you're going to sell like the 1,000 put, because its volatility is going to be, at 100. But you're trying to show the highest implied volatility you can while still receiving a reasonable amount of money. What's reasonable? If I'm spending $10, I probably at least want to get $2, $2.50 for what I'm selling.
Well, like the 1960, 1875 is, let's see, $6.50. And you're buying a 14.4, selling an 18.4 vol.
And what happens if you end up taking your long put and rolling it higher from 1960 to 1975?
Then it's
probably going to be closer to $10, $11 again, right?
$9.
Perfect. Now, I take a look. Which one do you think is going to end up paying you off more most of the time? The 1975, 1875, 100-point wide call spread, or just flat out buying the put 25 points lower? I'm 25 points closer to the money with the vertical, and it's still costing me a little bit less.
Yep. Yeah, your break even is going to be a lot higher on that 1975, 1875.
Right, right. Much better. And if you take a look at my theta is going to be working for me in a much better shape. Now, if you do drop, and it does drop very quickly, very fast, the implied volatility is going to hurt me a little bit. I get that. But overall, unless we're going to end up moving lower than 1875 over the next, 35, 40 days, I'm going to end up being better off buying that vertical.
Oh, great. Well, that's it for the questions. So I don't think there's anything else I've got. Do you have anything else, Jim?
Nope, that's it. It's, I'm going to end up continuing trading, in a risk-defined fashion, and thinking that the VIX will continue to end up, floating sideways to in, and the market will float sideways to up. Once, if the technicals start to end up turning, I reserve my right to change my opinion, but the technicals need to start to turn before I get worried.
Right. All right. Well, I guess that's it. There's no more questions, so I think we'll wrap it up and respect everybody's time and let everybody go do whatever they need to do.
Thanks, Tom.
All right. Thanks, everyone. Take care.